Hello, everyone, and welcome back to the Safe, Simple Sound podcast. I'm Alex, and I'm thrilled you're tuning in. Here, our mission is always to guide you toward financial freedom through strategies that are, you guessed it, safe, simple, and sound. If you are a freelancer, a contractor, or a small business owner wearing a dozen different hats every day, this episode is specifically for you. We are going to help you seize financial control of your business by removing the fear and confusion around taxes and audits. Today's episode is based on a comprehensive guide titled Build Your Bulletproof Business Record-Keeping System. This article tackles the often dreaded task of maintaining business tax records and flips the script. Instead of viewing it as a chore, we look at it as the ultimate form of protection for the business you've worked so hard to build. We're going to highlight some fascinating takeaways from this piece, including the specific difference between a bank statement and a valid receipt, the reality of IRS audit-proof standards, and exactly when you can legally shred that mountain of paperwork sitting on your desk. We believe in simplifying the complex, and nothing feels more complex than the IRS. So let's get started and build a system that keeps your business safe. Now, before you tune out or skip ahead, hear me out. I know that for most of you, whether you're a freelancer, a creative, or running a trade business, bookkeeping for small business often feels like a massive chore. It's the thing you do on a Sunday night when you'd rather be watching Netflix. But I want you to shift your perspective today. Think of your business like building a house. Your product or service is the beautiful framing, the windows, the curb appeal. But record keeping? That is the concrete foundation. It is non-optional. The IRS requires it not just to annoy you, but to ensure you can monitor your progress and prepare accurate business tax records. Without that foundation, the house sinks. Here's the good news, and something a lot of DIY entrepreneurs don't realize. The IRS does not mandate a specific system format. They don't care if you use expensive software, a spreadsheet, or an old-school ledger. However, they do require two non-negotiable elements. First, a collection of original supporting documents. These are your receipts, your invoices, your bank slips, the raw evidence. Second, a summary of transactions, essentially your books. Think of it like a court case. The supporting documents are the evidence in the baggies, and the summary of transactions is the lawyer's closing argument that explains what that evidence means. You cannot win the case with just one or the other. You need both. This brings us to the concept of an IRS audit-proof system, or what I like to call a bulletproof system. A bulletproof system is defined by one thing: its ability to withstand inspection. Let's use a relatable analogy. Imagine you have a messy garage. If you need to find a specific Phillips head screwdriver, it might take you an hour of digging through boxes. That's a stressful, messy audit. Now imagine a garage with a pegboard where every tool has a labeled outline. You find that screwdriver in 3 seconds. Organized records are that pegboard. They accelerate IRS examinations because you aren't scrambling. They substantiate every dollar of income and every credit you reported on your tax return. So here is the mindset shift I need you to make today. We have to stop viewing bookkeeping as glamorous work, because it isn't, and start viewing it as a critical compliance tool. It is a shield. It protects the business you've worked so hard to build. I want you to pause for a second and reflect on your own setup. I've got a question for you. If the IRS requested to inspect your records today, not next month, but this afternoon, would your current system be considered complete and organized? Or would you be diving into that messy garage? And secondly, how does distinguishing between those supporting documents, the raw receipts, and a summary of transactions, the list, change your approach to your daily management? Are you keeping one but forgetting the other? We're going to get into the nitty-gritty of how to gather that evidence in just a moment. But let's wrap this foundation up. The key takeaways are: 1. Record keeping isn't just a chore. It's a legal requirement and the bedrock of your business health. 2. You need two things: the raw evidence docs and the story, the summary. 3. An organized system is your best defense against a drawn-out audit. Here is your homework before you listen to the next segment. I want you to conduct a quick audit of your current system. Just open your files. Do you have the original documents and a summary method in place? If you're missing one, flag it now. In our last segment, we talked about building a bulletproof foundation and why small business record keeping isn't just a boring chore, it's your shield against the IRS. But a shield is only as strong as the materials it's made of. So let's pivot from the why to the what. If your tax return is a court case arguing that you owe less tax, your documents are the evidence. Today, we are diving into evidence gathering, managing supporting documents, and expense tracking. Think of your business life as a series of transactions. Every single one of those entries in your books needs a buddy, a supporting document. These documents act as the legal evidence for every entry. You can't just have a shoebox mixed with gum wrappers and receipts. They must be organized by year and by type. We're talking gross receipts, expenses, assets, and, if you have a team, employment taxes. Now, let's get into the nitty-gritty of expense tracking, because this is where I see so many DIY entrepreneurs fall into a trap. I want you to picture this. You're doing your taxes, and you see a charge on your bank statement for $200 at Superstore Mart. You think, great, the bank statement proves I spent the money. Done. Wrong. To be truly IRS audit-proof, proof of payment alone is insufficient. The IRS knows you spent $200 at the store, but they don't know what you bought. Was it office supplies for the business, or was it groceries for your family barbecue? To lock this down, you need two things. One, the proof of payment, like the canceled check or credit card statement. Two, the invoice or receipt that details exactly what was purchased. Without that itemized receipt, that deduction is technically invalid. Next, we have to talk about assets. These are your heavy hitters: machinery, high-end computers, maybe office furniture. You cannot treat these the same way you treat a box of paper clips. Asset records require a specialized approach. You need to document when you bought it, the purchase price, the cost of any improvements you made to it, how you used it, and eventually, the selling price. Why the extra homework? Because to calculate depreciation or capital gains correctly when you sell that asset, you need that full history. And finally, let's look at the money coming in, your gross receipts. This evidence includes your cash register tapes, bank deposit slips, and for my freelancers out there, those forms 1099 MISC or 1099 NEC. If money hit your account, you need the paper trail to prove where it came from. Reflect on this for a second. Are you currently relying solely on bank statements for proof of expenses? If an auditor asked to see the invoice for that software subscription or that client lunch, could you produce it? And are you differentiating between your standard business expenses and your long-term business assets in your filing system? If the answer is no or I'm not sure, don't panic, but do take action. Here is your homework for today. I want you to review just your last month of transactions. Scan through your bank feed and identify any expenses where you have a bank record but are missing the physical or digital invoice. Go find those business receipts now. Download them, scan them, save them before they get lost in the digital abyss. All right, so we've just wrapped up talking about gathering your evidence, those receipts, invoices, and bank slips. That's the raw material. But having a pile of raw material isn't a building, it's just a pile. Now we need to construct the framework to hold it all together. This brings us to our next big piece of the puzzle: system setup. Specifically, we're going to talk about simple bookkeeping for small business and how to make that leap to digital without landing in hot water. I know the phrase system setup sounds like you need an IT degree and a CPA license, but for most of you listening, my fellow DIY entrepreneurs, it's actually much simpler than you think. Let's start with the basics. First off, let's bust a myth. You do not need a complex double-entry accounting system that looks like it belongs at a massive corporation. For most small businesses, single-entry bookkeeping is perfectly practical and sufficient. Think of single-entry bookkeeping like your old-school personal check register. You are simply tracking the flow of income and expenses based on a daily or monthly summary. It's a log. Money in, money out. Simple, right? The goal isn't to impress an accountant with complex charts. The goal is to have a clear narrative of your financial story. However, there is one non-negotiable rule here. The most critical step in your setup is establishing a dedicated business checkbook. I cannot stress this enough. You must separate your personal and business finances completely. This is the golden rule of small business record keeping. Ask yourself right now, Does your current workflow strictly separate business transactions from personal ones, or are the lines blurred? If your bank statement looks like a mix of client payments, grocery runs, and Netflix subscriptions, you are walking on thin ice. Commingling funds makes it incredibly difficult to prove to the IRS what was a legitimate business expense versus a personal splurge. It turns an audit from a headache into a nightmare. So separate those accounts. Now let's talk about the 21st century. I know many of you are itching to go paperless. You want to clear the clutter and move to digital record keeping. That is totally fine and honestly recommended, but there are rules. When you transition to digital, your system has to meet specific standards. I won't bore you with the legal text, but the gist is this. Your digital records must be legible, retrievable, and indexed. Ideally, you shouldn't just be dumping scans into a random folder on your desktop labeled taxes. You need an index. You need to be able to search and retrieve a specific invoice from 3 years ago. Here's the kicker that trips people up. Whether paper or electronic, the system must produce a complete record accessible to the IRS. This means you can only destroy your original hard copies if your digital storage is fully compliant and tested. If you are using a digital system, have you verified that it meets these specific indexing and retrieval requirements? If your hard drive crashes tomorrow, is there a cloud backup? If the IRS asks for a receipt from 2021, can you find it in under 5 minutes? If the answer is no, do not shred that paper yet. To recap, keep the bookkeeping simple with a single entry method, keep your funds strictly separate, and if you go digital, ensure your system is audit ready and backed up. So here is your call to action for this segment. If you haven't already, open a dedicated business checking account immediately. Stop mixing your money. And if you are already digital, go verify your backup and retrieval protocols today. Make sure your digital fortress is actually secure. Once you have that system running, the next logical question is, okay, Alex, I have the records, but when can I actually throw them away? Stick around, because up next, we're covering the retention roadmap, exactly how long you need to keep those tax records before you can hit delete. Let's be honest, most of us fall into one of two camps regarding small business record keeping. You're either the shred-happy minimalist who accidentally throws away last month's invoices, or you're the anxious archivist holding on to receipts from a sandwich you bought in 1998. Today, we're going to find the middle ground. We're talking about how long to keep business tax records so you can declutter without the panic. Here's the breakdown, and it's all about what the IRS calls the period of limitations. For the vast majority of your standard paperwork, receipts, invoices, bank statements, the magic number is 3 years. You generally need to keep records for 3 years from the date you filed your original return. Think of this like the expiration date on canned goods. Once that 3-year mark hits, the IRS generally can't assess additional tax, and you generally can't amend the return to claim missed credits. Now, don't fire up the shredder just yet. There are specific scenarios where the timeline extends significantly. We call these the 6 and 7 year rules. If you accidentally underreport your income by more than 25 cents, which is a huge margin, but it happens, the IRS has 6 years to check your books. And if you file a claim for a loss from worthless securities or a bad debt deduction, you need to hold those records for 7 years. This is where IRS record retention trips people up. Assets, things like your computers, machinery, office furniture, or real estate, have their own timeline. You must keep records for the entire life of the asset, plus the limitation period after you get rid of it. Why? Because when you sell that laptop or that building 5 years from now, you need to prove what you paid for it to calculate the gain or loss. Also, if you have a team, employment tax records are a distinct category. Keep those for a minimum of 4 years after the tax is due or paid. The goal here isn't to scare you into hoarding. It's to give you an IRS audit-proof strategy. Understanding these timelines allows for the confident destruction of old files. It reduces your digital or physical clutter while ensuring you remain compliant if an audit ever happens. I want you to take a second and look around your office or your Google Drive. Are you holding on to decades of paperwork out of fear, or are you following a structured retention schedule? And more importantly, which specific assets does your business own right now? Do you have the original purchase invoices for that expensive camera or that 3D printer? Remember, the 3-year rule doesn't start for those until you sell them. Here is your mission for this week. I want you to create a simple, one-page document called a retention schedule. Stick it on your wall or save it to your desktop. List the disposal dates for your tax years based on the 3, 6, and 7-year rules. For example, write down 2020 tax records, dispose after April 15, 2024. Taking 20 minutes to do this now will save you years of storage fees and anxiety later. And that wraps up our deep dive into building your own bulletproof system. Today, we stripped away the intimidation surrounding small business record keeping and proved that staying compliant doesn't require a degree in accounting. We started by learning that effective bookkeeping for small business isn't about complex software. It's about having those two non-negotiable elements, your supporting documents and a clear summary. We also busted the dangerous myth that a bank statement is enough for expense tracking, reinforcing the need to keep those original invoices to ensure your business tax records are truly IRS audit-proof. For me, the standout moment was finally getting a clear answer on how long to keep business tax records. Understanding the specific IRS record retention timelines, whether it's the standard 3-year rule or the longer requirements for assets, is the key to confidently decluttering your office and embracing digital record keeping the right way. Until next time, keep your records clean, your anxiety low, and your strategy clear. This is Alex, signing off.